Okay, hi there everyone. I'm James Harte and welcome to this Forex trader education session where we're going to be taking a look at the top technical trading patterns. So as ever, we're going to jump straight in and start looking at what these trading patterns are. So at the heart of technical analysis is simply the study of price action. Okay, so that is all technical analysis is. And in terms of studying price action, there are different ways we can do this. We can look at things like support and resistance. We can look at the candlesticks themselves. We can use trend lines to help us. And another way is to actually look to identify patterns which reoccur in the markets. Because over time, traders have noticed that certain patterns tend to crop up in the markets again and again. And from studying these patterns and the way that price behaves before, during, and after the pattern occurs, traders have been able to work out how to take advantage of these different formations. So in this session, we're going to focus on a few of these patterns. I'm going to show you how to identify them, talk about what they're telling us about the market and price behavior, and then most importantly, we're going to talk about how we can trade them. Okay, so as I said, if you have any questions during the session, please just write them in the chat function and I will stop as we go along. Okay, so first pattern then is the wedge. Okay, so we have the rising and the falling wedge. So the wedge is a classic chart pattern that remains one of the most popular among price action traders as it can often yield powerful breakouts. So you can see here that the wedge is simply formed by two converging trend lines. And we have both the bearish version, the rising wedge, and the bullish version, the falling wedge. So we'll take a look at each of these in detail and I'll talk about them a bit more. So here we have the falling wedge, okay, and you can see, as I said, this is a bullish pattern which is formed by converging trend lines. And essentially what this pattern shows us is a narrowing range, and it highlights that momentum in the market is contracting. Okay, so the market is moving in a bearish mode, we're moving lower, but these converging trend lines tell us that the market is starting to lose steam, and you can see that this lower trend line is a lot flatter than the upper trend line. So this tells us that buyers are stepping in earlier and earlier each time. And so once we identify this pattern, once we see these converging trend lines, we know that we should be on the lookout for a bullish reversal. Okay, so once again, what this pattern is showing us is a contraction in bearish momentum, a loss in bearish momentum, and it's alerting us to the potential for a bullish reversal. So we identify a breakout of the pattern then as a break above this resistance trend line. Okay, so once we've got the pattern in play, once we've identified the converging trend lines, we're monitoring price action, and in terms of how we're looking to trade the pattern, we're simply waiting for price to break out above the bearish trend line. So this is the bullish pattern. Obviously we're looking to buy the market, so we're looking for price to break higher. Now in terms of how we actually go ahead and execute a trade then on this pattern, there are two ways we can do this. The first is to simply enter a long trade as price breaks out above that resistance trend line. However, this is a slightly more aggressive approach because we aren't waiting for any confirmation here, and what we open ourselves up to is the risk of getting in on a false breakout where price pops above the resistance trend line, we enter long, and then price ducks back down and closes inside and reverses. So the other approach, which is the one that I prefer, which is slightly more conservative, is where we wait for a candle close outside of the pattern. So in terms of how we go ahead and enter this trade, you can see we'd wait until the market closes outside that bearish trend line rather, confirming the breakout. We then go long on the break of that candle, and in terms of our stop, we can simply place our stop below the last low of the structure. So in this example then you can see how that worked. We'd enter long here on the break of the candle, price moves slightly higher, we get a small retracement lower, however, we don't take our stop out, and then price continues to sail on higher. So as I say, this is a very straightforward and simple pattern, but as we mentioned, looking at that beautifully drawn diagram, the brilliant thing about this pattern is that it tends to yield powerful breakouts. And as I say, we can play this in a very straightforward manner. So we wait for price to close outside of the pattern, we enter long, and then we have our stops below the low of the structure. And then our target, as we've talked about in all our sessions, is always going to be a minimum of 2 times risk. And then beyond that, How you manage the trade is, of course, up to you. But at a very minimum, we want to look to be targeting at least 2 times our risk. So that's the bullish version of the pattern. This now then is the bearish pattern. So this is simply the inverse of what we saw with the falling wedge. So this is the rising wedge, and this time you can see that we have 2 rising trend lines, but once again showing that contracting range. Okay, so we're seeing these 2 converging trend lines, which tell us that momentum is contracting in the market. So the market is losing bullish momentum, and this alerts us to the potential for a bearish reversal. So this time, because we're looking at the bearish pattern, we're looking to enter a sell trade. And so the way that we go ahead and trade this pattern is waiting for price to close below the low of the pattern. Okay, so you can see we traded all the way up to this high point here. We pierced the pattern top slightly. We've reversed, traded all the way lower. And then at this point here, you can see we've comfortably closed below the low of the pattern, below the trend line of the pattern rather. So at this candle close here, we've breached the pattern on a closing basis, confirming the shift in momentum in the market. And so we can go ahead and enter our short trade on a break of that candle low. And then again, our stop just goes above the structure high. Okay, so with the falling wedge, we were entering long as price broke out above the pattern with our stop below the pattern low. With the rising wedge, we're entering short as price breaks down through the pattern with our stop above the pattern high. So as I say, these wedges, really fantastic patterns to look out for. And the thing about wedges is that they can help be a really good indicator, early indicator rather, as to an oncoming reversal. And unless you're quite savvy and you're well schooled, well studied in your pattern analysis, if you were looking at a chart like this and you saw price moving higher, you'd simply be looking at a bullish market and expecting price to continue higher. So you'd be looking at this leg here as simply a retracement within this bullish trend. However, once you can identify this falling wedge pattern, you know that the market is actually losing bullish momentum, and the better opportunity is going to be to the short side. So this is a really great example of where knowing your patterns can help you get into the market ahead of other traders and make better trading decisions at key market points. Okay, so the next structure we're going to look at then is the flag. And again, another classic structure here, one that I use a lot, and it's one that's been used by trend traders for many years to great effect. So where the wedging pattern is a reversible pattern that tends to occur a lot during the end of a trend, the flag pattern is more of a continuation pattern that tends to occur during the trend and offers traders the opportunity to enter the market as the trend resumes. So essentially what the flag represents is a correction within the trend and then a continuation. Okay, so for the bullish flag, we have price moving higher. We have a retracement lower, which occurs within this bearish channel, and then a break of that bearish channel, signaling a continuation of the bullish trend. With the bearish flag, we have an initial bearish move, a correction higher, which occurs within this short-term bullish channel, and then a break of that short-term bullish channel and a continuation lower. So another really nice and simple, straightforward pattern that you can identify very easily, but we'll show you on the charts now just how effective it can be. Okay, so here we have a bearish flag formation then. So you can see that the price was moving lower initially. So we had our initial bearish move, this large sell-off. We then got a correction higher, and the market was forming this very choppy, overlapped period of price action. So we go ahead and draw in our trend lines there, and you can see we've got our 2 bullish trend lines in place, giving us a nice bullish channel. And so once we've got this channel in place, we're simply waiting for a break of the channel. Okay, so we know momentum is moving to the downside. We've got this big initial bearish move. Price is correcting higher within this short-term channel. We wait for the channel to break at this point here, and that's where we get short, looking for price to continue that initial bearish move. So the fantastic thing about this then, as I say, is it's very, very simple to spot, because you'll tend to see that we get these long extended moves, a shorter period of choppy price action, and then more extended moves. So long as you're able to identify your trend lines correctly by connecting highs and lows, then you'll find this a very easy pattern to trade indeed. And in terms of how we actually go ahead and enter trades using this pattern, as we talked about with the wedge, what we're always looking to do is wait for price to close outside of the pattern. And the reason for this is simply to add in a little extra confirmation as a bit of a safety feature. So if we wait for a candle close, we're a little less likely to suffer any false breakouts. So it's all about managing our risk and trying to improve our chances of success. So we wait for the candle to close outside of the flag, we enter our short trade, and then again our stop simply goes above the structure high, and we're looking to target a minimum of 2 times risk. And again, because this is a trend trade, you can look to hold it for longer if you like, and simply manage the trade as it develops. So we just looked at a bearish flag, and this time we're looking at the counter pattern, which is the bullish flag. So again, this time you can see the market was rising higher. We were trending higher in this series of higher highs and higher lows, which is typical of a bullish trend. But at this point here, we started to get a steeper correction lower. And you'll notice we were able to go ahead and draw in our 2 bearish trend lines, giving us a bearish channel. So at the point that we've got this channel in play, we know that we have a potential flag setup. And then once again, it simply comes down to monitoring the boundary of the pattern and waiting for price to break out. So you can see at this point here, the price broke out above the pattern high. We closed outside, so we'd enter long on the break of that bullish candle. And then once again, our stop very simply goes below the low of the structure. This is just to allow for any retest of the breakout zone, which can tend to happen. And then we're looking to target a minimum of 2 times risk as price takes off. So hopefully what you're starting to see by just introducing these very basic patterns is how simple pattern trading can be, okay? So you don't have to make this extremely complicated. It all comes down to identifying very simple, reoccurring structures and looking for high probability outcomes, and then designing a really simple, manageable way to trade them. So we know that the market moves in this mode of expansion and contraction. So all we're looking to do is identify a way to capitalize on this. So what we've got is our market moving higher, a correction lower, we've identified the bearish channel, and then we look to trade the break higher for a continuation of that bullish move. So a really, really nice pattern here, and like I say, fantastic for trend traders, whether you're trading trend intraday on the 5-minute chart or you're trading the daily charts for longer term position plays. Okay, let's take a look then at our next pattern now, one of my personal favorites, and that is the double top and the double bottom. So some classic reversal patterns here, and simply what these patterns represent is a strong rejection at a specific price level, highlighting the likelihood of a reversal in sentiment. So we've got our basic structure here. You can see the double top, also referred to as an M top, where price travels up, hits a high, is rejected, trades back up, tests the high, gets rejected again, and then suffers a larger sell-off. Similarly with the double bottom, price sells off, we hit a low, we bounce higher, trade back down, retest that low, fail to break it, and then we get a larger reversal higher. So these are very simple, very straightforward patterns to identify, but they can be particularly powerful when traded correctly. So let's take a look at an example of this on the charts. Okay, so here we have a fantastic example of a classic double top. So price has rallied all the way up to this first high point. Sellers have stepped in and driven price sharply lower. We've made it all the way down to this point here, where buyers have once again stepped in, driven price back up. We've tried to break that high. You can see we've pierced it slightly, but then we've reversed and sold off. And you can see we've got that lovely M formation in play, which we just looked at in the diagram. So in terms of how you trade this pattern, we have 2 options really. So the first is the more aggressive option, and this is where you simply look to trade from the second top. So in this instance, you would be monitoring price action, looking for bearish reversal candles. And a classic way to do this is to trade a break of the candle that occurs at the double top. So you can see that this bullish candle formed as we tested that first high, giving us the double top. So we would look to enter short on a break below that candle low with our stop just above the top of the structure. And again, we're looking to bank a minimum of 2 to 3 times risk. Now, a slightly more conservative way to break this, to trade this pattern rather, is to wait for a break of the reaction low. Okay, so this level here, where sellers took price down, buyers stepped in, drove price back up. So once price trades back down, we know that this is basically the pivot point of this pattern. So if price is going to see a larger sell-off, it's going to occur after it's broken down below this level. So once price breaks down below this low level, we can enter short here with our stop above the pattern high. And then again, we're simply looking to bank a minimum of 2 times risk with our trade. Now, another really fantastic way to trade these patterns is to look to identify confluence with indicators. So using indicators to help confirm the trade. So if we're anticipating that the bullish trend is going to reverse from this level, and we're looking for a double top to signal a reversal lower, then what we can do is look to use indicators to help confirm this move. And one fantastic indicator that we can use for this is the RSI indicator. So the RSI indicator is a momentum indicator that identifies the market as being either overbought or oversold and therefore likely to reversal. And one of the really great ways that we can use this indicator is using divergence. So if we go ahead and look at this same pattern, but this time with the RSI indicator turned on, and I'll talk you through what we're seeing. So price has traded up to this high point here. You can see as the market has been moving higher here, each time we put in a new high, the indicator has been putting in a new high also, showing that bullish momentum is growing in the market and buying pressure is getting stronger. However, after we get this first sell-off here, and then we trade back up to retest that high, notice that even though price has broken above that initial high, the market has actually put in a lower high. So you can see we've got this sloping line showing that we've put in a lowish high. So when we see this happen, we know then that the indicator is telling us that bullish momentum has weakened in the market, buying pressure has lessened, and the market is potentially going to reverse lower. So what we're seeing then is a double top pattern, which we know is a classic bearish reversal pattern. And we're also seeing bearish divergence on the relative stochastic index. So when we see these two elements occurring in confluence, we know that we have a really good chance of getting a short trade on. So this is how then we can use indicators in conjunction with basic pattern analysis to highlight really powerful trading opportunities. So the bullish version of that pattern then is simply the double bottom. And this time we're simply seeing the same dynamics but in reverse. Okay, so price has traded all the way down to this low point here. We've put in our initial low. We've seen a bounce higher as buyers have stepped in, traded all the way back up to the reaction high. Sellers have stepped in again and driven price lower. We traded all the way down to this low point here, where we've tried to break below the low of that initial low. And once again, you can see we've actually pierced it slightly. However, what we've then seen is buyers stepping back in and driving price back up sharply higher. So what we're seeing this time then, like I say, is simply a reverse or the inverse of what we saw with the double top pattern. Okay, so the double top simply indicates a rejection at a resistance level and a potential shift in sentiment towards selling pressure. And a double bottom then simply indicates a rejection at a support level and a potential shift towards buying pressure. So again, in terms of how we trade this, we have two options. We can either trade the price action around the low, and if we look at this low, you can actually see we've got a lovely bullish pin bar here. So you can see, for those of you who are in the candlesticks webinar, which we did recently, you'll know that the pin bar is a candle that I focus a lot of attention on. So you can see this lovely long tail candle here with a small body. So this is another classic reversal signal in terms of price action. So for more aggressive traders, and for those of you who like trading candlesticks, at the point that you see this pin bar occurring at the double bottom, you know that there's a very high likelihood that the market is going to reverse higher. So this is a really great example of where we can use price action to help us with these trades. So we've identified a double bottom formation, which we know is a good telltale sign that the market is going to reverse higher. And then we've identified this bullish pin bar. So what we can do is look to go long on the break above that pin bar high with a stop just below the low of the pin bar. And then once again, we're looking to target a minimum of 2 times risk. Now, the great thing about entering in at this point here is that it's obviously really close to where our stop needs to be. So we're getting in right at the start of the move if it occurs. And this obviously opens up the potential for greater profit maximization. Now, the higher risk with entering the pattern in this way comes from the fact that the pattern hasn't necessarily formed. Okay, so we've seen price trade down into the double bottom. However, we don't know yet that a double bottom is actually in play. And so really, until this reaction high, until the neckline is broken, we don't technically have a double bottom in play. So as I say, entering in this manner is a slightly more aggressive approach. However, if you're doing it in a controlled way, based on solid reasons and with good risk management in play, if you're combining these price action signals such as a pin bar, then you have a really good shot with this pattern. Alternatively, as we discussed with the double top, your other option is to wait for a break of the reaction high. And so you'd enter long at the break there, and you'd have your stop below the low. Now, this is a slightly more strategic and more conservative way of entering, and the only downside to it really is that what you're actually doing is sort of widening your risk, because obviously the distance between here and here is greater, so your stop is going to need to be greater. So essentially, you're going to need to see a bigger move from the market in order to get your target. But traders play these patterns in both ways and find great success with them. So it really comes down to your personal trading preference. And as I say, the focus should always be on sound and solid risk management, whichever strategy or method or indicator you're looking at. Okay, so let's move on then and take a look at our final pattern, which is the triangle pattern. This is another one of my favorites, and it's another one which can be fantastic in trending markets, just as we saw with the flag. So if I can just refer you then to these expertly drawn diagrams, which you're so lucky to have created for you. You can see that the red lines are highlighting the trend lines, which we draw ourselves in the market to identify the patterns. And then these black zigzaggy lines are the price. So triangles then can work on both sides of the market. They can be bullish and they can be bearish. So it simply depends on how you're looking to trade them. So if you're looking for a breakout above the triangle, then obviously you're looking to play a bullish triangle, and vice versa. If you're looking for price to break down below the triangle, you're looking for a bearish triangle. Now, essentially, all the triangles are telling us is that the momentum in the market has stalled and we've seen a contraction in volatility. So typically, as I say, we'll see these patterns occur during trending markets where the market is expanding in one direction before stalling, and we see a contraction in momentum. And then these two trend lines, these converging trend lines, as we see with the wedges, tell us that momentum is contracting and that the market is entering a period of compression. Now, just as we saw with the wedges, the really great thing about this pattern is that it can tend to precede really powerful breakouts. So this is another great pattern to use for trend traders. And when you start to get really good at identifying these patterns, you can start to make some really fantastic trades. And as I say, the brilliant thing is you can use these on all time frames. So you can trade them on the 5-minute charts if you're a short-term day trader. You can trade them on the weekly charts, if you like to be sitting on a trade all year. So it really comes down to your own personal trading preferences, but they're just as effective on all time frames. So let's take a look at an example of these patterns on the charts then and talk about how we play them. Just quickly to answer a question, which is the indicator used below? So the indicator I was talking about with the double tops is the RSI indicator, the Relative Strength Index indicator. Pardon me. Okay. Right, so here we have an example then of a bullish triangle in play. So as I said, let's talk through what's happening here. The market is moving strongly higher initially. You can see we've got this really big, expansive bullish move. We then top out at this point here. We hit a resistance level. Price starts to retrace lower, but we don't reverse lower. We simply enter into a block of consolidation. So as the market is chopping around in this range, you can see that we're able to go ahead and draw in our converging trend lines. So what we're doing is connecting rising lows, connecting falling highs, and we've got our converging trend lines in play. Now, once we've got these converging trend lines in play, we know that we're looking at a triangle pattern, okay? So you can see the triangle here. This tells us that the market has entered a period of compression. However, we know because of how the market moves, this compression isn't going to last forever, and so we're looking to take advantage of the eventual breakout. Now, as I said, because we're looking to trade this in the direction of the trend, we're anticipating that we get a bullish breakout. So what we're looking to do again is trade a price breakout above the top of this high. And as we discussed with the other patterns, what we're looking to do is wait for confirmation of the breakout by way of a candle close outside of the pattern. So once prices close outside of the pattern, we can go ahead and enter in our long trade. And then all we're looking to do is put our stop below the low of the structure. Now, because we're trading a triangle pattern here, what I would say is that there's no need to put your stop all the way down below the very low of the structure. And what I would look to do is simply put your stop below the last low in the structure. Okay? So you can see how we've got this very last swing low that's touching the rising trend line. So if we're entering long here, our stop would go below that low. And then again, we're simply looking to target a minimum of 2 times risk. So as I say, these patterns are very straightforward to trade, and essentially because all we're doing is looking to identify a period of consolidation or contraction within a defined range, all we really need to see is a break of the pattern and a close outside of the trend line to go ahead and enter our trade. And then again, because we're looking to trade this in the direction of the trend, because the market was moving in a bullish move, before the triangle formed, we'd simply rather play to the top side, okay? And the reason I say rather play is because that was where the momentum was before the pattern occurred. So we'd rather play to the top side because we anticipate that the market is going to continue on a bullish trend that was starting. However, it's very important to bear in mind that we need to always be focusing on trading what we see and not what we think, okay? And so it is definitely advisable to look to trade triangle patterns in the direction of the trend, because trading with the trend, as we know, is a solid approach and tends to yield the best results over time. However, it's also worth noting that triangle patterns can offer fantastic reversal opportunities because, as we discussed, they're simply highlighting a loss of momentum and a loss of volatility in the market. And while this also occurs, while this also occurs during trend consolidation, this also occurs at the end of trends and tends to yield a reversal in the trend. So we should always be on the lookout for potential triangle pattern situations where we think the trend might be coming to an end. So let's look at this example here. Okay, so in this chart here then, you can see prices moving strongly higher. We've got these big explosive moves. We trade all the way up to this high point here, however, where we hit a clear resistance level. You can see that sellers have stepped in 3 times there, driving price lower. We get our sell-off, however, we don't completely sell off. We start to trade higher. So we're going along, we're trading up and down within this pattern. You can see we've got our contracting, converged trend lines rather, which tell us that the momentum in the market is contracting and that volatility has lessened. And so while we're anticipating that we eventually get a break higher in line with the bullish trend, it's prudent to be alert to the potential for a reversal lower, okay? And you can see that we do in fact get a breakdown through that pattern low. And so this time, all we're looking to do, again, is once more sell as price breaks down through the pattern low on the candle close. So we wait for the candle to close outside of that pattern low, confirming that the reversal has taken place. We enter our short trade, and then once again, our stop simply goes above that structure high. So this is a really lovely, simple way to capture reversals in the market. And as I say, while we can anticipate that a bullish move is likely to occur, if we're wrong and that bullish move doesn't occur and price breaks down through the pattern, there's no reason why we should sit that trade out, because what we're actually seeing is a really nice topping pattern here where we're seeing a shift in momentum, a loss of volatility, and then price is expanding, but this time we've had a reversal to the downside. So this is another really great way that you can use these patterns to trade. Okay, everyone, so I hope you really enjoyed that session today. It was fantastic to go back and look over some of these patterns which I've been using throughout my trading and analysis career and which I still rely on a day-to-day and weekly basis in the markets. And I hope you've gained a lot of useful information in that session that you feel that you can take to the markets now. And as always, with these sessions, the one thing I would highlight is the best results come from spending the necessary time practicing identifying your patterns in the market, and spend some time journaling. You don't have to start hitting these patterns straight away. You can spend some time journaling what you expect the market to do based on the patterns that you've identified. Keep a track of how you're doing in terms of your forecast, and then ease yourself into it. But really, the best results will come from spending time identifying the patterns. And yeah, if you want to shoot me any questions, please feel free. For anyone who's missed the session today or calls it late, the recordings will be sent out, so don't worry about that. Yeah, thanks a lot for joining me today, and I look forward to catching up with you all next time. In the meantime, take care and best of luck with your trading. Thank you.